So that our core markets, health and beauty, are actually doing quite well. So that has also helped us.
Well, Donald, just looking at those results, return on equity up to 46.2%, and at the end of last year, it was at 42.3%, an already high number. And it seems to be just pushing that a little bit higher again, but surely at some point the cost cutting and the efficiencies that we have seen coming through have to start leveling off.
Well, certainly, although, I think the market's really starting to, understand Clicks as a growth story. And certainly I think the focus is on potential market share gains specifically in pharmacy for Clicks over the course of the next 5 years. And I'd actually be interested to know, from David, in terms of what do you actually think the level of market share growth is that Clicks will be able to achieve over the course of the next 5 years?
Well, we've said that our goal is to... Hello?
Yep, David, go ahead.
Sorry. We've said our goal is to take Clicks to 500 stores over the medium term. That's the next 3 to 5 years. We've got a 12 share of pharmacy at the moment, and our goal is to take that to 30%.
Well, David, we know that the competition is becoming rife in this, pharmacy industry because other retailers are starting to catch on to the trend as well. You're saying that you want to increase your market share, but obviously you are going to be facing other companies that are going to be doing exactly the same thing. What is going to give you your competitive edge?
I think that two things. First of all, the quality of patient care in Clicks pharmacies, and secondly, value. We welcome competition. It's helped make medicines more accessible, more affordable in this country. So we have to run a very efficient operation, as I said, that offers good value, but at the same time delivers great patient care.
I'm just curious, I was quite surprised to see in your prospect statement quite a cautious outlook, and it's quite interesting to see. We're actually seeing this theme with a number of companies at the moment, where the companies are, particularly in the retail space, are still relatively cautious over the course of the next 12 months. Yet we have economists jumping up and down about the resurgent consumer in South Africa. Is your view, is Clicks taking maybe an overly cautious approach to the South African consumer, and what do you see the upside over the course of the next 12 to 24 months?
Look, I think when we give a prospect statement, we're typically talking about the next 6 to 9 months. But certainly at this stage, we can't see any evidence that consumers are out there spending much more heavily than they were. We think they're still worried about debt. We still think they're worried about job security. So they're going to be cautious. And that's how we're planning the business. So we just can't see that in the next 6 to 9 months. The unknown, of course, is what impact the World Cup will have on retail spending. And we'll know that in August, but we don't know it now.
David, talk to us about progress at UPD perhaps, and just the integrated healthcare retail and supply model that you are working on, because we chatted about this a year ago, and you were making strong progress there. Are you still seeing it?
Yes, we are. I mean, I think what we're particularly pleased with in our wholesale business is the growth from actually the buying group that we manage for independent pharmacies called Link. There, our sales in the past 6 months have grown 35%. So in a sense, we have an interest in the pharmacy profession in total, and in ensuring that pharmacy has a role to play in the primary healthcare system and the delivery of primary healthcare system through both our Clicks pharmacies and through Link pharmacies.
Donald, are you concerned about the competition that we will be seeing down the line, given that other retailers are adopting a very similar strategy?
Well, certainly I think particularly in the retail space, everybody's always looking for market share gains. But in Clicks' case, I'm not really too concerned about it, because here you have a unique business model. Health and beauty with pharmacies is something that actually, looks like it's going to work quite well in South Africa. It is working quite well. And clearly the numbers speak to that. And if you look at the offshore models, it's a model that works particularly well. So I think Clicks is actually quite unique in that it's a business model that's going to be quite difficult to replicate.
Well, David, when we spoke 6 months ago, the release of your previous results, music sales looking pretty flat. Of course, we were coming up to the Christmas period, and that is obviously when you would expect to do well in a store like that. How has that come through the first half of the year? And how are you also adapting just to changes that we're seeing in the music industry, where people aren't going out and buying a whole bunch of CDs anymore?
Overall music sales were still pretty flat. Actually, music sales, CD sales, were up by a couple of percent. So CD sales have proved remarkably resilient. What impacted us in the past 6 months was that in the previous period last year, we had the launch of the DVD of Mamma Mia, which was the world's biggest and fastest selling DVD, and we didn't have anything of comparable scale in this 6 months. But in truth, first of all, I'd have said CD sales are holding up well. And secondly, what we're doing in music is broadening the offer. So a wider range of DVDs, a wider range of gaming, and certainly in gaming, we were pretty pleased with our performance there, where sales were up by around 8%.
David, some investors would say that they're concerned about the kind of bandwidth changes, the broadband changes that we're going to be seeing in South Africa. Of course, new cables being laid all the time. So internet will become cheaper and faster in South Africa. And some say that this will directly impact Musica because consumers would rather go onto the internet and download DVDs, movies, music, and so forth. Are you concerned about the sustainability of your Musica model, and how are you going to change strategy, if at all, if we do see cheaper and faster internet in South Africa?
Look, I think there's no question that over time, internet penetration will grow in South Africa. But if I look at the US, where internet penetration is at its highest, still 75% of music sales are in the physical format. So wider internet penetration doesn't kill CDs. And Musica is well placed to be the last man standing. It's a great brand, great prices, great shops. So we'll stay in music, and we'll take share in music. At the same time, we'll expand the brand's offering so that, as I said, it's an entertainment retailer with a broader range of DVD and gaming as well as CDs.
Well, perhaps just compare Clicks with some of the other defensive retailers. Of course, we had Pick n Pay out with results yesterday, slightly different year-end from ShopRite's and the Spars and those. But they are all looking quite expensive at current levels. Pick n Pay particularly above 21 PE. We have Clicks around 18, 19, and most of the others as well. Well,
you know, I mean, I think when you look at the valuations on these businesses, it really, to start off, you look at the value, and then the second of all, you look at what the growth prospects are. In my mind, I think, you know, Clicks has surprised the market in that it's actually quite a defensive retail play, where I think, you know, 2-3 years ago people might have seen it more as a cyclical. The difference is with the food retailers, you know, you've got to ask yourself, where's the growth going to come from? There's potentially going to be margin pressure from decreasing agricultural commodity prices, whereas on Clicks front, you potentially have opportunity for market share gains. You know, for ShopRite to increase market share gains against Pick n Pay, there's going to be margin compression. It's quite a competitive environment, and I think, you know, although, as you know, I'm not a huge fan of retailers at the moment, I think they're all very expensive, the Click story is quite unique. What I am concerned about, though, unfortunately, is the Musica model. It's all good and well to say that you've got a sustainable brand and a sustainable market share, but where's the growth going to come from? And I find it very difficult to believe that you're going to be able to grow that market in South Africa. To use a comparison, what mobile did to fixed line telephones globally, the internet is doing to CD sales.
David, your view on Body Shop, and we know that during the tough times it seems consumers were still heading over to the Body Shop, especially to buy those gift packages that you were putting together. What kind of trends are you seeing right now?
Well, certainly the Body Shop has outperformed the premium beauty market. Big growth out of bath and body products, out of fragrance products. The beauty market is always driven by innovation. And there's a very good new product pipeline of products coming into the Body Shop in the next 6 months. So we're very optimistic about that. And we're also piloting the best of the Body Shop in Click stores. We've got it on trial now in 10 stores, and we're pretty happy with it. We've got some work to do, but that's another path to growth for the Body Shop in South Africa.
David, just prospects for the remainder of the year, and also you've outlined some of your growth plans, 500 stores over the next 3 to 5 years. That's where you'd like to be. How are you seeing competition coming through at the moment from players such as Dis-Chem, and we know they're rolling out that franchise model, and also Woolies veering into pharmacy at the same time?
Look, as I said before, I mean, we can expect that other players will come into the pharmacy market. Competition is good. As I said, it's bringing prices down, and Dis-Chem is an awesome competitor. They keep us on our toes. What we have to do is carry on with what we're doing, which is building the Clicks brand.